Thank you everyone for joining us for our end of year tax planning webinar. We're really excited for the session today. My name is Lizzie Morrissey and I am with NFP Insurance Solutions. Really quick before we get started, a few logistical things. So we have allotted an hour for this webinar and most of the time will be spent with our expert panelists discussing the topic with some questions that we've prepared. If you do have a question for the panelists, we have a Q&A feature at the bottom that you'll be able to use. So during the time, if a question comes up, please submit your question at the bottom. And if there's time at the end, we will address those. So without further ado, I am excited to introduce our host, Howard. One moment here. So Howard Sharfman is the Senior Managing Director at NFP Insurance Solutions, and he is an industry expert with over 30 years of experience. He has been ranked as one of the Forbes top financial security professionals in the country, and he is a frequent speaker. He's been published in several articles, and he's very involved in industry organizations. For example, he is the president and chairman of the Forum 400 and also the chair of the Finseca Foundation. So very excited to introduce Howard, to introduce our other guests as well.
Thank you very much, Lizzie, and welcome and thank you to today's webinar series. We appreciate your investment of time in today's webinar. I am so honored and pleased to have two amazing industry veterans with me as panelists. Let me introduce them. First, David Handler is a partner in the trust and estates practice at Kirkland and Ellis. He specializes in trust and estate planning and administration of high net worth administration for high net worth individuals, business owners, private equity principals, and family offices. He has extensive experience in advising on private equity and venture capital fund planning, as well as establishing administrative private foundations and charitable organizations. A fellow of the American College of Trust and Estate Tax Council, ACTEC. He's a member of the NAEPC Estate Planning Hall of Fame. He was ranked #1 by Chambers USA for wealth management, and he was widely regarded as a leader and authority in his field. David has been recognized as Chicago Lawyer of the Year by the Best Lawyers in America and has received the Austin Fleming Distinguished Service Award from the Chicago Estate Planning Council. More importantly than all of that, I can call him a dear friend. We also have Steve Dolans with us today. We're so honored to have Steve, who is the co-founder of the Dolans Group with his father in 1993, bringing his finance and accounting experience to serve clients with a focus on quality work, personal service, and building long-term relationships. With extensive experience working with individuals and businesses, Steve is committed to ensuring their financial success and stability. His philosophy is, if our clients are successful, we are successful, period. He also serves as treasurer of the Northbrook Baseball Association, the Northbrook School District 30, and he has been appointed as a member of the Illinois Gaming Board in 2016. We are so very fortunate to have Steve and David on our call today. I'm going to pose to them a few questions and about year-end planning. So the first one is, what are the most important strategies high net worth clients should consider as part of their year-end planning? And we'll start with David.
Thanks, Howard. So the most obvious to anyone in the estate planning area would be using the annual exclusion. It always comes up quickly. I tell my clients, just make these gifts every January. Why wait till December? The annual exclusion this year is $18,000 per donee. So it's been increased for inflation. Next year, it's going to be $19,000. So a married couple could give $36,000 to as many people as they want. That's children, grandchildren, parents, siblings, nieces, nephews, sons and daughters-in-law. There's no limit. Friends, as far as making those annual exclusion gifts. Don't wait till the 31st. If you write a check and it hasn't cleared before the end of the year, it's not going to count. So hand over cash if you're going to do it on that day, but do it well in advance. These gifts can be made in various ways. It can be outright gifts. They can be transferred to trusts, trust for children, trust for parents, trust for whomever. These can be grantor trusts where the grantor pays the income taxes, enhancing the benefits. One thing that's been of interest to clients of mine in the last couple of years is so-called friends and family trusts. It's not uncommon for wealthy people to want to help their extended family and sometimes groups of friends. And sometimes they want to give them $100,000 and their exclusion is 18 or 36. So I've had many, set up many extended family trusts or friends and family trusts. So there's annual exclusion gifts made to all the siblings and all the nieces and nephews and the parents. You can build up a trust like that very quickly, to hundreds of thousands of dollars per year of gifts. And then the trustee can have flexibility to make distributions among any one or more of them equally or unequally over time. Same thing with friends. I've had some clients do similar trusts with friends. Last, these gifts can be made to 529 plans as well. So 529 plans can receive annual exclusion gifts. They can receive other gifts as well. 529s have an added benefit. You can front load 5 years worth of annual exclusion gifts. So you could put 36,000 times 5 into a 529 plan today. You'd call up Steve and say, hey, I did one of these. You got to make an election on my gift tax return to spread it over 5 years. Otherwise, it will be a large gift and you use gift exemption. So you can front load 5 years of gifts, but you do have to make an election on a gift tax return to do that. And the purpose behind that is education is expensive. Let's get a bunch of money in early so it's got time to grow tax-free before the beneficiary starts using the money in college, grad school, and whatnot.
Excellent. And Steve, do you have something to add there? I'm sure you do.
Sure. Thanks for inviting me. So for 2025, the upcoming year, we find that tax rates are going to be pretty similar to what they are in 2024. So our suggestion to our clients is to continue to play the deferral game, to be able to defer income, taxable income to 25 for the time value of money. Not only is the time value of money to pay the tax at the same rate next year, better than paying it now, but it's also going to reduce your requirements for what you need to make for minimum quarterly estimates next year. So it's a gift that could keep on giving for 2 years if you're able to defer income as well as accelerate expenses. Now, at this time next year is going to be a totally different conversation because we feel in 2026 it's going to be a different tax world. And at that point, very possibly tax rates are going to be higher. Many programs and credits are going away. So at that time, that might be a time that we're going to want to accelerate income and defer expenses. But that's a year from now. So for planning for this particular year, the idea is to grab your deductions now, knowing that it's going to be basically the same values if you took them next year. So if it's funding charitable accounts to get a tax deduction on your personal return before year end, if it's making your mortgage payment on December 30th instead of January 1st, if it's on a business side, paying your business expenses before the end of the year rather than wait until January. Even payroll, you got to be careful when you do payroll through your business. You got to make sure the pay date is before the end of the year so you could take that expense this year rather than next year. Those are the type of things that we want to try to have clients capture this year. If there's any unrealized losses and any unrealized gains, they may want to consider taking those before the end of the year so they could book that expense right now. And the only other, not the only other item, but there's many items, but another thing to consider is to make sure before the end of the year, you have what's called your safe harbor amount of taxes paid in. And one way to do that, if you're a business owner, is you could do that through your W-2. So if you give yourself a bonus and you put it towards withholding, anything that shows up on your W-2, the government considers to be paid equally throughout the entire year. Your quarterly estimates are obviously very transparent. They know when you made them. If you're a day late or a dollar short, you're going to get charged interest. But the withholding on your W-2 gets dated to the beginning of the year. So that might be some before the end of the year if you need to get some extra withholding paid in, because your target, everyone needs to either have 90% of their actual liability paid in or 110% of their prior year's liability paid in. By accomplishing that, you stay out of a interest and penalty situation. You can pay the balance due in April of 25 if you end up owing additional money. But you at least want to make sure you address those items to get that paid in before the end of the year. And the only other thing that's a little different is a few years ago, the government got rid of the SALT deduction for state and local taxes, whether it's real estate taxes, state income taxes. People used to always want to prepay their real estate taxes before the end of the year. They'd always want to make their state income tax estimates before the end of the year. That's a little bit tricky right now because that deduction is no longer available. So we're encouraging people not to accelerate that deduction where you get no benefit, but rather defer it until when it's really due, because potentially by deferring it and paying those expenses next year or the year after, the SALT deduction may go away and you may be able to take those deductions at that time. Not to make things too confusing, but if you're a business owner, it's a little bit different where potentially you could do what's called a PTE election to allow your business to pay your state taxes, take it as a business deduction, and then take credit for that on your personal return. That's something you definitely want to take advantage of. And that is something you could pay before the end of the year because that is not subject to the SALT limitations. So that's something to consider as we approach year-end planning.
Excellent. Steve, what are the penalties if you don't have either 90% of your current liability or 110% of last year's liability?
So right now it's about 6%, but it's annualized. So it's not like, oh, I missed my fourth quarter estimate, so I got to pay 6% on it. That's basically if you miss all of your estimates, and then it gets prorated after that. The higher interest rates and penalties is if you don't have your minimum taxes paid in by April 15th, by the due date of the return, because that's when an additional level of interest and penalties will kick in. But remember, to use the government, even if you think 6% isn't that much as a bank, is not always the wisest idea. This is non-deductible interest. So we always recommend to do whatever is necessary to avoid paying the interest on those underpayment of estimates.
Excellent. And on the other side of that, what strategies should a client avoid doing? We hear a lot on the news. We hear a lot on the internet. What strategies should they avoid? Steve, why don't you continue on that, and then we'll go to David.
Sure. So a lot of times business owners may consider booking losses, accelerating depreciation, doing certain things that what I'm trying to say may not give them a current year's benefit. So for instance, a business owner might want to take Section 179 on a piece of equipment. If it's going to generate a loss for them, that's something they're not going to be able to take. We have conversations with our clients what to do as they approach the year end, depending on what their profits look like. That potentially one, that deduction might be better in future years. But if we do want it for this year, we need to make sure we're doing the right thing, whether it's bonus depreciation, Section 179 depreciation, because they have different aspects on the state level as well, as far as what you have to add back. So you want to be careful of what to accelerate with there. Some other things you want to be careful of before the end of the year is you want to, well, I know we're going to get into maybe some charitable giving later and what to do and what not to do, but get with your CPA before the end of the year, because it happens more often than not that you have a conversation after the year's over and we'll say, you know what, that would have been a great strategy or great plan to do before the year is over. And each person has a different circumstance that we may have wanted to either do a conversion to a Roth or not do a conversion into a Roth or fund a retirement account timely or set up accounts. Something like a solo 401k, even though it doesn't have to be funded before the end of the year, it needs to be open before the end of the year. So if you're not sure of what type of plan to have open, you need to get that consultation now, because if you miss that, that could be very costly of not having that opportunity.
Excellent. And David, what strategies do you think people should avoid?
I don't know if there's any per se do not do this strategy, at least the ones that are in the mainstream. If you read anything online and didn't consult your advisor, then avoid that one. In general, I have a philosophy of don't make gifts you don't want to make just because you can give away assets. I know we're going to talk about the gift exemption in a little bit as well. But whether it's annual exclusion gifts or other gifts, don't make gifts that you're going to lose sleep over. It doesn't matter what your net worth is. If it causes you to lose sleep, that's not a gift you should make. Another one, and this ties in a little bit with the charitable that we're going to get to, If you've got a pending sale of your stock in your company, that is not the time to make the charitable gift. That was 6 months ago. If it's a very facts and circumstances situation, but there have been a number of big cases the last couple of years where it wasn't a done deal yet, but it was close enough to a done deal. And someone gave their stock that was going to be sold to a third party, to a donor advised fund or other public charity in order to avoid the gain and get a deduction. And they were dinged by the IRS saying, no, you did not avoid the gain. It was too far down the path. So usually when the client asks, they say, oh, it's already at point X, it's probably too far down the path. That's a decision to make, many months before then.
Excellent. It sounds like clear communication with your advisors solves a lot of these problems and creates opportunities. So a lot of the deduction strategies involve structuring charitable gifts before year end. You had just mentioned that. David, could you talk about that and some strategies for charitable gifts?
Sure. The best thing you want to give away for charitable gift is appreciated assets. If I give away cash, $100,000, I get a $100,000 deduction. If I give away $100,000 of low basis stock, I get a $100,000 deduction, and I avoided gain on that low basis stock because I didn't sell it. I just gave the stock to the charity. So that's ideal. A lot of clients look around and say, well, I don't have much low basis stock. Unfortunately, I gave it to my trust, well, maybe fortunately, and it has since appreciated. And so it's in my kid's trust. Well, if that's a grantor trust, you can do a swap and get those low basis stocks out. So take my cash, I'll buy the appreciated stocks from my grantor trust for the benefit of my kids, equal exchange. Now I have the low basis stock and I can make a donation of that stock. And my trust is better off as well because it now has cash with full basis, obviously, because it's cash. So look around at the assets when you're about to make the donation of, well, what do I have, but also what's in my grantor trust. Maybe I can use those.
And David, you would do the same thing with a grantor trust if someone potentially is going to pass away in the near future. Is it reasonable to swap assets, low basis assets out of a trust and cash into the trust to obtain a stepped up basis?
Absolutely. So I tell my clients, please advise us if you plan on dying, give us a heads up. I have done I can think of 2 very large swaps within weeks before the client passed away. I prefer not to cut it that close, but you suggest maybe we should do the swap now. You're 92. Well, who knows? They can live 10 more years, which is true, but maybe not. But taking the low basis stock out of the trust, exchanging it for cash or other high basis stocks, is then in my estate, I get a basis step up and we completely eliminate the gains. If I die with the low basis stock in the grantor trust, the gains will not be eliminated. That trust will eventually pay the tax on those gains, and they're far worse off. So it's a huge opportunity to take advantage of that.
Absolutely. And Steve, anything to add there?
Yes, David makes a wonderful point that obviously with the donor advised fund, which I'm a huge fan of, is to donate your accelerated or your large unrealized gains that you have in appreciated assets. But the tax angle on it is it's very popular to lump your charitable gifting into a given year. And this really came into play a few years ago when, the government increased the amount of your standard deduction that an individual could take, as well as limiting the amount you could deduct for those SALT taxes. So your SALT limitation is $10,000 a year. So even if you're paying $50,000 a year in real estate taxes and $100,000 a year in state income taxes, you're only able to deduct $10,000. So if your standard deduction that the government gives you already is, say, $27,000, and let's just say your mortgage interest, either you have no mortgage interest or your mortgage interest is only $10,000, that's only $20,000 of itemized deductions, which means the next $7,000 you give to charity, you're not able to get a tax deduction for it. So if an individual is giving, let's say they give $20,000 a year to charity and they have no mortgage interest. Well, that $20,000 may only be giving them a $2,000 or $3,000 a year deduction. So over a 5-year period, they're going to give $100,000 away, only deduct $2,000 or $3,000 a year. They're only going to get $10,000 deduct on that $100,000 they gave the charity. Whereas if they lump that entire $100,000 into a single year, put it in the donor advised fund, they still have the luxury to disperse it to whatever charitable organizations they want over their lifetime. So it's not like they have to get rid of it right away, but at least we front load that tax deduction and we don't get phased out by that incremental benefit. So I love the idea of putting the money in, lumping it, so we don't have years of making a potential deduction that we're not taking advantage of.
I have
Excellent.
clients that like donor advised funds for one other reason as well. So my clients make, 100 charitable gifts over the year, thousands of dollars, $50 here, or $500 there. They're going to have 100 receipts that they then send to you, Steve, for their tax return filing. Instead, they could make the gift an annual gift to a donor advised fund. That's the one receipt they need. Then they dole out the charities from the donor advised fund, because they get one deduction upfront and then they dole it out to the charities over time, and then they don't have to get 50 different receipts.
Of course, yeah, and the administration is wonderful. Just the ease of when you want to make a charitable deduction, instead of on your own having to go out and cut that check, mail it out to them. The administration is wonderful, so it's very easy just to make your charitable donations. And if we could just go back one more step, I had one more item on the year-end planning that we want to make sure clients don't avoid and that they absolutely capture is there's something called the Augusta tax rule. And this is becoming more, I'm trying to make it more popular with our clients to take advantage of this. And what this is it actually got its name from an historical group of families in Augusta, Georgia, that during the Masters, they always rented out their homes. And you're able to rent out your home for up to 2 weeks without having to recognize your income. And this is part of the IRS code. This is section 280A, that any individual, whether somebody wants to rent your home for the weekend, part of your home, you want to rent it for a movie set, you want to rent it out for an Airbnb, you want to rent it out for a special event going on, take advantage of it, because it will be tax-free income to you as long as you rent it for less than 14 days. Now, where I mentioned, why does that have to do with the year-end planning, is you could really take advantage of this strategy when you have your own business. So your business can rent your home for a limited number of days. Use it for business use, use it for meetings, use it in place of having to go out and rent another facility. And that way you're generating a business deduction before the end of the year and not having to pick it up personally. So that's a good trade-off.
So Steve, let me just repeat that and make sure everyone understands that. An owner of a business can rent his or her home to the business, use it for a Christmas party, use it for corporate meetings, use it for a retreat, pay, I assume, a reasonable rental rate for that, and then deduct it at the corporate level and not pick up the tax at the individual level. Is that correct?
That is exactly correct. That is the absolute strategy that we put in play.
Absolutely. Fantastic. Regarding the charitable planning, David said this about making gifts to family members. Don't make the gift unless you actually want to and can afford to make the gift. We feel the same way about charitable gifts, but to capsulize that, just think about if someone has low basis or no basis stock, it's worth $100,000 and you're at 25% plus or minus long-term capital gain rate. You can give $125,000 away instead of $100,000 and have it cost you the same economic number, or give away $100,000 and actually have it only cost you $75,000, which is something worth doing.
For sure.
So let's move this to retirement plans a little bit. How can business owners leverage retirement plans and life insurance and other estate planning tools to reduce their income tax burden before the end of the year?
Is that for me? Would you like me to start with
Sure, David.
that? I'm sorry, David, go right ahead.
Either one.
Oh,
Go for it.
So what I'm going to talk about won't necessarily mitigate income tax, except for one thing. So what we haven't talked about is the big gift exemption. Big because it's double what it's ever been. 13.61 million this year. Next year, 13.99 million per donor. So next year will be $28 million for a married couple. And as you've probably heard over the last 7 or 8 years, unless you've been under a rock, it's expiring at the end of next year. And there are some that are suggesting you better do it this year because there will be a new Congress and a new president next year. And they can pass a new tax law and lower the exemption even sooner. And that is true. And they could also raise the exemption, and they could make it sideways or any which way. So I've gotten out of the prediction business. But my advice to clients is, if this makes sense for you, back to rule 1, don't give away what you don't want to give away, then you should make this gift now. And if it doesn't make sense for you, it might not make a whole lot more sense in January than it does in September, October. You're either able and willing to part with the assets or whatever amount you're able and willing to do, or you're not. Any client that's doing this next December is doing with a gun to their head, and they're going to regret it for doing it, because either they're able and willing to part mentally and financially, or they're not. But it's a huge opportunity. Steve and I have been practicing long enough where, it was a $600,000 exemption, and to get it to 13 million was going to take 25 years. And now it can be, 13, 14 million just by making the transfer. How are we doing that? Doing that just grantor trusts, so-called slats, which is basically an irrevocable trust where the spouse is a beneficiary. People are talking a lot about reciprocal slats. So I'll set one up for my wife and kids. She'll set one up for me and my kids. And so now there's 13, 14 million available to each of us while we're both living. I've effectively parted with nothing. And if one of us dies, then the other still has the other 14 million, whatever it's grown to, plus hopefully other assets. It's not without risk. So one, don't make them reciprocal trusts. Don't do them at the same time. Don't have the identical terms. Try to vary the assets. Second, if one spouse dies, you have parted with half those assets. And third, typically these trusts have a so-called divorce clause. So if I set up a trust for my wife and kids and we divorce, I don't want her to be a beneficiary of that anymore, and she'll feel the same way. Well, now neither of us has access. And we've parted with those assets. It's just for the kids. You can eliminate the divorce clause, but then you have the issue of it stays as a grantor trust. So I'm paying taxes for a trust for my ex-wife and kids, and she's paying taxes for a trust for her ex-husband and kids. And maybe mine's bigger than hers, and I'm paying more taxes. I'm not going to be happy about it, neither is she. But as long as the spouse is a beneficiary or former spouse, then it stays a grantor trust. So that goes back to, don't give away assets if you aren't really ready to part with them. Life insurance can be a hedge. So I could set up a slat, put $13, $14 million in for my wife and kids, and I can turn around and buy an insurance policy on my wife. So if she passes away, that trust is just for the kids. I don't have any indirect access through her anymore, but I got a $10 million payout for my life insurance or whatever it is they bought as a hedge. So that can be done. The other way life insurance, is being used, if you've probably read about PPLI, private placement life insurance. That is, I don't consider that an estate planning strategy. I consider that an income tax / investment. It's an investment with minimal insurance, the minimal amount you can have to still be insurance, wrapped around investments. And then you avoid income tax on all those investments, and ultimately it turns into a tax-free death benefit. So that is something to consider. It's not necessarily a year-end thing, but it is, I have many clients looking at it and using it. But back to the exemption. So In 2026, it's going to revert back to half. So probably about, well, we know it'll be 14 million plus, because next year's 13.99. They'll go up with inflation again for 2026, but also slice in half. So 7.2, 7.3 million apiece is what it'll be in 2026. In order to be ahead of the game, so if the exemption is 13.6 today, and it might go down to 7, giving away 7 or less is not going to take advantage of anything. Because if I give away 7 today and it goes down to 7, then I have none left. I have to give away 8 or 9 or 10 or 13 to take advantage of this exemption and be ahead of the game. But there's various ways. Trust for the kids into a slat. It's a great way to fund your life insurance. We have many clients, they've got large premiums. Maybe they're doing loans, or maybe they're doing split dollar. You could take care of the whole thing today. Put the $3 million in, pay off the split dollar, fund the trust so it's got enough money while we can to cover all the future expected premiums. And then last, doing these in generation skipping grantor trusts just supercharges the whole thing. Take your 13 million, put it into a generation skipping trust, let that thing roll for, a generation or two. Obviously, your kids can benefit from it as well. But I always find it fascinating to run the numbers on anything for 80 or 100 years, and it gets to some astronomical figure if you have that much time to let it compound. And if it's in a grantor trust during that time, it's growing income tax free, at least until the grantor dies. And the benefits, it's just massive, the difference between the grantor versus the non-grantor trust compounding, and then not having a tax in every generation being generation skipping. So this is the time. We've got the big exemptions, opportunity to use them. One other thing I'll mention is a lot of clients have done sales to grantor trusts. So they did their 5 million gift, 10 million gift. They sold their stock to a trust, FLP to a trust, took back a note. Well, you could forgive the note as a gift now. You've got the gift exemption. Now's the time to do that. Forgive the note, make a gift to the trust, have the note paid back, however you want to do it. But this is an opportunity to do a lot of cleaning up of trusts that had a lot of leverage for insurance, for sales, for whatever it is. And we can do some cleanup now, just even by forgiving these notes, not transferring additional assets.
Thank you. And Steve, just to remind you of the question, how could business owners leverage retirement plans, life insurance, and estate planning tools together to reduce their tax burden before the year closes?
Well, thank you. And just to add another item onto what David mentioned, which he did such a great job on, is it also is worth a discussion to know what type of assets we're going to be gifting away, not just the dollar amount, but to look at what we feel like are going to be the assets that are going to appreciate the most outside of our estate. Once we give those assets away, keep in mind there's no stepped up in basis in those assets. So decide if there's something we want to keep for the step up rather than gifting away. And also the ability to take a discount. In some circumstances, some assets you might be able to give away $20 million out of your net worth, where after you take a discount for lack of marketability, lack of liquidity, lack of control, that it only counts as 14 million off your estate. So there's many things to consider on that. But as far as the planning as we approach the end of the year and different types of payroll planning, retirement planning, a lot of times business owners consider putting on their spouses and their children on their payroll of their businesses. It's quite often that when you have a closely held business, that the family is doing some work for the business, and there's no reason not to add them to the payroll. The benefit of doing something like that is, one, not only are they able to potentially qualify for the retirement account that the business has, but they might be able to qualify for their own individual account. So it's very common. You might give a child, $10,000 of payroll for the year. Business takes that as a tax deduction. Child reports that as income. It's lower than the standard deduction, so the child pays no income tax on it, and they're eligible to fund a Roth IRA. So if they do nothing, we lose the tax deduction and we can't fund the Roth IRA. So this is the government actually giving us a tax deduction for something that we want to do. We want to be able to put as much money as possible into a Roth IRA. This is one of the possible ways to generate earned income for a child to be able to do it. And a lot of times, you might add a spouse to take advantage of a 401k, depending on what your plan is at work. So if you could afford it and if you need the tax deduction, that's something definitely to consider before the end of the year.
One thing I want to add, since you mentioned basis for gifts, it does matter. So it's on one hand, you want to give away the asset you think is going to grow the most, generate the most income. Because $1 million gift that can grow into $10 million is better than $1 million gift that grows into $2 million. But definitely take basis into account. Just to give you a sense, if I give away an asset that has 50% basis, so it's worth $1 million, basis is $500,000. So on minute one, I'm losing a basis step up of $500,000. I'm behind. If I die the next day, that was a losing transfer. I used some gift exemption. I would have had it the next day when I died for my estate exemption. It didn't appreciate yet, but I did lose the basis step up. So that was a bad move. The family actually lost money. And to put that in numbers, the asset has to appreciate 77%. If it's a 50% basis asset, it has to appreciate 77% before you are net ahead in terms of saving estate taxes minus the loss of basis step up. Because don't forget that $1 million asset with 500 basis, when it goes to 2 million, it still has 500 basis. So we have $1.5 million of loss of basis step up. So we're getting ahead more and more on saving the estate tax over here, but we're getting further and further behind on the basis step up. And we started out behind. And so it needs to grow 77% before we're at equilibrium. And then every nickel above that, we are definitely 100% ahead. Now that 77% is not an annual, that's a total number over time. Doesn't account for income that might be generated by it. And then that's where the swap we talked about earlier can come into play. So if I put in a low basis asset and it quadruples in value, but it's still low value, it's still low basis. If I'm smart enough to buy it out before death and never pay the taxes, then what I just said with the 77% gain is irrelevant. Or if it's going to be sold by a grantor trust during my lifetime, where I'm going to pay the taxes on it anyway, then that part's irrelevant as well, because we weren't going to get a basis step up. But all things being equal, a slower growing asset with a high basis could be better than a faster growth asset than a low basis. But you got to look at all these factors.
And David, couldn't we have the best of both worlds if we transferred, let's say, a liquid asset with high basis into a grantor trust, and thus, if we consider this a game, won the estate tax game, but now we've put ourselves in a negative situation for a basis gain or a loss of a stepped up basis. Let's say that trust is enforced for 30 more years before the grantor passes. Wouldn't a perfect solution to that be then allocating those assets to a private placement life insurance policy where you replace the stepped up basis with tax-free life insurance death benefit?
Yes, no, exactly. Whether inside the trust can invest in private placement life insurance, then there's no tax being paid by anyone, even, grantor trust or not, or investing on the outside as well. That's why I said I don't consider that an estate planning strategy, the PPLI, is an income tax strategy for whoever the owner is more than anything else.
Excellent. And we talk about these gifts as, making gifts either in a slat type situation or any other type of grantor trust. What type of communication do we have to the ultimate beneficiaries of this asset? I know there's been some new regulation around that.
So as far as informing beneficiaries, under general trust law, trustees are supposed to inform the beneficiaries that there's a trust for your benefit. These are your interests. This is what the assets are. This is what we are doing with the assets each year, so they can make sure they're not, they're running the trust properly and not stealing the money or anything else. On the other hand, there are statutes now, including in Illinois, that allow appointment of a designated representative. So I could name Howard as the representative for my trust, and all the information about its operations would go to him on behalf of my minor kids. In Illinois, it's capped at age 30. After age 30, you got to tell him. But he could be the one who basically says, okay, I'll get all the information sort of as a representative for the kids, making sure everything's above board, and until age 30. There are other states like Delaware that don't have an age limit. In my experience, the banks don't want an unlimited age. The highest I've seen one go after some pushing and prodding was, I think, age 40. Most don't want to go past 35 in terms of just a matter of practice of they should know. And you're going to run into practicalities. You know, you're going to make a distribution. One of the kids, were they going to leave just a bag of cash on their front door because they can't know that there's a trust. So how could they get a check from a trust? And they're going to get a K-1 from a trust. So, but I don't know that there's a trust. So the cat's out of the bag at one point or another. And by the way, as soon as one of the kids know, they're going to tell their siblings, regardless of age. So, but that is a possibility in a popular structure.
Excellent. And a whole nother webinar we could have on communication with children and how to make sure assets only work to help the next generations and not do any harm, which is, of course, all of our clients. That's the goal of all of our clients. Steve, anything on that subject?
No, I agree with everything that David said. The communication is the key to know what type of assets to put in and take advantage of the gifting. You know, the one thing on the PPLI to consider is it's still a good asset to keep in the trust and keep it out of your estate. So even though it is an income tax play because you're going to generate tax-free earnings, you don't want that death benefit inside your estate. So anytime you have insurance, you want to be able to own that outside of your estate in a trust.
Excellent. And finally, one other question. I just want to go back to the tax changes, January 1st, 2026 or December 31st, 2025. Any other things that we haven't covered that we should discuss on that?
Well, one item is the qualified business income deduction is set to expire. And what that is that's for business owners that have pass-through income, whether it's an S Corp, LLC. You're able to take advantage in certain industries to take a 20% discount on your income. So you make $1 million, you're only paying tax on $800,000. That's a great discount. That's set to expire. And it's much easier to let something expire than regardless of what side you're on, then get enough votes to get it reinstated. So I think there's a high chance that it may expire. And if it does expire, then this is going to be an opportunity that in 2025, business owners are going to want to accelerate as much taxable income as possible, knowing that that might be the last year of opportunity they have to get a 20% deduction. So what that means is if the top tax rate today is 37%, is the top income tax rate, your business income potentially is only getting taxed at 29.6% because you're paying tax on 80% of your income. So 80% of 37 is the 29.6. So every incremental $100,000 of profit you make, you're only paying 29.6. It is very possible that not only does that 20% go away, but tax rates go up to back to 39.6, which is the last top tax bracket. So you're talking about a 10% increase just at a minimum on that business profit. And a lot of times that comes into play also when clients are discussing if and how much to contribute to their retirement accounts. Because even though I'm a huge proponent of retirement accounts, they need to realize still you get your tax deduction today, obviously, on a federal and state level, and you pay tax on it when you take it out in the future. And the idea is in the future, you're going to be in a lower tax bracket. You pull the money out at a lower tax rate, and you get the time value money and defer the compounding of the earnings every year of not having to pay tax on it. What people have to understand is even if you're in the top tax bracket, that tax deduction right now on the federal level is only 29.6% on a business contribution. If you made an individual contribution, which on income that was not subject to the qualified business income deduction, then it could be the 37%. But on a business tax deduction, whether it's the business making a profit sharing or a defined benefit contribution or a safe harbor contribution, SEP account, that's still only saving them that 29.6. Now, one thing to keep in mind is many states, including Illinois, doesn't tax retirement money. So when you pull it out, so there's a value, even if someone says they're going to be in the same tax bracket later, or they might be in a higher tax bracket later, at least know you get to keep that state money. So when you make a contribution today, you're saving federal and state taxes. When you pull it out later, you're only paying federal tax on it. So that's a very popular strategy. Even if I tell someone, hey, you're eligible to put, $60,000 into your SEP account, and they're like, well, that sounds great, Steve, but I just don't have the cash flow to do it. Well, if they're over 59 and a half years old, I simply tell them to take the 60 grand out of their IRA and put it right back into their SEP account. And that's totally allowable. You get a federal and state tax deduction for the money going in and only paying federal tax on the money going out. So you get to keep the 5% of the state's money for swapping that out. You get the time value of money, which means you could get a tax deduction for the year before, because you have until October 15th of the following year to make your retirement contribution. And then you don't have to pick up the income until a year later when you replenish your cash flow for that. So there's a lot of strategy as to if and when to put that money into the retirement account, and just be careful for the future tax rates that potentially might be going higher in the future, that you got to recapture that money when you pull it back out.
Excellent. And Steve, that deduction you referred to on business income would be referred to the 199 deduction?
That's exactly correct. Yeah, that's
Okay.
the 199A deduction. It's the qualified business income deduction that's set to expire.
Excellent. And so everyone understands that with the stroke of a pen, one could not just extend all of the deductions that are about to expire. It involves finding pay-fors for that, meaning that the government needs to create income to replace the lost income that would happen if they extended that for a certain number of years. So it's not so easy to just say, oh, we're going to extend these like political candidates may. They need to find a pay-for, and it is at the expense of something else, and that something else always has constituencies.
Sure.
So now, guys, anything that you would like to share that I missed, and if not, I have a couple questions from the audience.
Well, the only thing I would mention is on the same lines is be careful if you were to do a 1031 exchange for the same exact reasons. Currently, you have a 20% capital gain rate. People don't want to pay the 20%. They put it in a 1031. Just be conscientious that potentially the rates might be higher in the future. Now, if you're going to hold it long term or pass away with it, a great asset to still do the 1031 exchange for. And also for anybody that took advantage of the qualified opportunity zones, those are all going to become taxable in 2026 as well. So to keep that in mind when you're doing your planning.
So, David, anything to add?
Nothing to add to that.
Good. Okay, so we have a couple of questions here. The first one from Les Carter says, Steve mentioned how W-2 withholdings are treated pro rata over the year. Is this similar to withholdings for RMDs?
So RMDs, yes. So if you have withholding that shows up on a 1099-R from your RMD, that absolutely would be considered the same as withholding on your W-2. So a lot of times people will take their RMD, which I think is this exact question, put all of it towards federal withholding, and that is considered being paid equally throughout the entire year.
Okay. Next question from Laura Dalton was, what are the odds that some of these tax proposals, like removing the stepped up basis at death or 28% capital gains tax, are passed next year? Any potential risk for Roths or Roth conversion? I'm actually going to start with the answer here because I'm pretty close to what we do in lobbying with Vinseca, our industry organization. Probably not next year, and then the year after that and starting next year is really the Super Bowl of rewriting tax rules. There will be massive fights and negotiations and lobbying going on for everything. I couldn't predict any thing that would happen after that because literally anything is possible. David and Steve, do you have any insight into any of that, especially the Roths or the Roth conversions?
Yes, as far as the Roths, everybody knows this is costing the government, billions of dollars. The rich get wealthier by taking advantage of the Roth IRA contributions and conversions, and I encourage everyone to do as much as possible. It used to be you could stretch your Roth out indefinitely. Obviously, they put the 10-year stretch on IRAs and Roth IRAs. When someone passes away right now, you can't stretch it over your life. You still need to take that money out over a 10-year period, so you lose some of that. I don't think the government's going to come out and say money you've already have put into the Roth and already have paid tax on, you're going to have to pay tax in the future. I think we're safe of that. I think where we're in danger of is them closing the eligibility of wealthier people being able to convert and contribute into a Roth IRA. I think that window may be going away. I feel next year is going to be a very popular year potentially. Right now, like I mentioned, 37% is the top tax bracket. If 12 months from now, we know that in 2026, rates will be 39.6 or higher, you're going to see a lot of people maybe converting even 37%. It's a great benefit for many reasons that we don't have to get into right now. But same thing happened when rates were at 35% before it went up to 37 and 39.6. A lot of people converted at 35%. So we might see a flurry of people converting. I think we're safe with the money in there. I think our window to do so may start to get closed.
Excellent. And would it be appropriate to describe converting to a Roth IRA and add this benefit, which is if someone is in a estate taxable situation and we convert a Roth IRA, yes, that's still included in one's estate, but the taxes that you're paying today are thus not in your estate and your savings estate tax on that. Is that a reasonable benefit for doing that?
Yeah, that's a reason for doing that, or literally pulling all the money out of your IRA prior to death and just paying the tax. Because if I own an IRA, taxable one, worth $1 million, it's $1 million item on my estate tax return. But if I pull the money out, there's 700 left, it's a $700,000 item on my estate tax return. So, because there's estate tax paid on the money that will be used to pay the income tax. Now, there is a deduction. So in the future, when if my kids inherit the IRA and there was estate tax paid on it, then there's a deduction they will get for the estate tax paid. But there is a double tax in effect, not dollar for dollar. So it's definitely something to consider.
Excellent. Another question came in from Jordy Berger. Could you still use your RMD for charitable gifts and still get the standard itemized deduction in addition to that?
I could take that. So I believe what his question is referencing is you are still eligible to take up to $100,000 out of your IRA to go direct to a charitable organization. Yes, that you could still take your standard deduction, because this event of going straight from an IRA to a nonprofit organization is not income on your return, and it's not a charity deduction on your return. So this is a way to get that quote unquote charity deduction by not having to pay tax on your RMD or your IRA withdrawal and still take the standard deduction.
But you don't get an income tax deduction for that. You just didn't have any income tax. It's a sideways movement, IRA to charity. No income tax, no deduction. Got to be 70.5. Cannot
Correct.
be to a advised fund. Needs to be to a public charity, not a DAF. And actually, it's 105,000 this year because there's an inflation index. Just FYI.
Wonderful.
Excellent. So in doing that, you're avoiding the income tax that you're paying and thus being able to give the charity more money.
Right.
For sure, because it's very common. I'll have sometimes clients take, $20,000, $30,000 out for their RMD, and then they made a $10,000 charity deduction, and I'm doing their return. I said, by the way, you got to pay tax on this 30 you took out, but I can't deduct the 10 you gave to charity because it's not more than the standard deduction. So I tell them in the future, just send the 10 direct to the 501c3.
Excellent. There's a lot of information that we talked about today. David and Steve, thank you so much for joining us today. I know there's well over 100 people on this, and there were some watch parties going on, so we could have had up to 150 people listening and learning. And one of my favorite things to do is help people learn and and share knowledge with them. So I know you feel the exact same way. And thank you so much. In closing, do you have anything else you'd like to add?
No, nothing for me. I'm glad I was able
Yeah.
to participate and join you guys.
Yeah,
Thank
thanks for
you.
having us.
Thank you very much. Lizzie, back to you.
Awesome. Thank you, everyone. That was great to hear your insights and answers to those questions. That was very helpful for myself and the group. So really quick, wanted to share Howard, David, and Steve's contact information with the group. If there's any questions that you have for them, feel free to reach out if there's anything that came up after the fact. So I'll have this up on the screen for a second here. And then additionally, if there's any other questions you have, feel free to reach out to me as well. Here's my contact information, lizzie.morrissey@nfp.com. So thank you so much for joining. We really appreciate it and hope that you found this session valuable.
Thank you very much.